Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 17th of November 2019, and we're asking the question, will the next financial crisis be a banking one or an asset management crisis? So let's investigate. Yesterday, we published our weekly gold and silver update report, and in it, we emphasized that equity markets are continuing to reach all-time highs, especially in the United States. Now, we've placed a link to that podcast video in the description box below, just in case you haven't had an opportunity to listen to it. Now, for those invested in equities, either directly or via funds, these continual highs are good news. But a former regulator and now compliance and regulatory supremo at Duff Phelps, a finance consultancy firm headquarters in New York, with 3,500 employees, a Ms. Monique Melis, suggests in a recent article published in the UK financial trade magazine Financial Advisor, which is published itself by the Financial Times, warns that there is the possibility that the next financial crisis, rather than being a banking one, such as witnessed in 2008, could actually be an asset management crisis instead. So let's listen to an excerpt of that article in order to gain an appreciation of the points that she is making. We could very well have an asset management crisis by Monique Melis. Questions should be raised around the level of cash that asset and fund managers set aside to deal with unexpected risks. Monique Melis, the compliance and regulatory global head at Duff Phelps, says, quote, "If a fund is free to take all your money and invest it into the markets as it pleases, should there be some buffer that underpins these funds so that if they dive, the investors do not lose all of their money?" Unquote. These questions are at the front of the mind for Miss Melis at the moment. This is because one of the tasks in her in-tray involves 3 investment funds in the United Kingdom and abroad, which have recently run into trouble. Miss Melis says, quote, "People will have lost money in these funds. A lot of that has to do with the way the regulations are constructed, the way funds are marketed to people, which quite frankly, I thought the regulations had sorted out," unquote. Miss Melis points to changes made in the banking sector following the 2008 financial crisis as an example of how rules were tightened. In 2007, the mortgage market collapsed as a result of banks lending money to people who could not afford to pay their mortgages. This set in motion a chain of events that caused the global banking crisis. Banks needed to be bailed out, and hence new measures were introduced to prevent a similar crisis happening again. Miss Melis warns, quote, "I really do not think we will have a banking crisis again, but we could very well have an asset management crisis," unquote. Her words might be described by some as doom-mongering, but the very essence of Miss Melis's job requires her to spot a looming crisis before it occurs. In her role at Duff Phelps, Miss Melis oversees a staff of 300, advising companies around the world on regulatory and compliance matters. She has previously worked for regulators, the Financial Conduct Authority, when it was the Financial Services Authority, and the Cayman Islands Monetary Authority. The interconnection between funds and investors means a major issue with a fund could potentially have wider market-reaching consequences, Miss Melis says. Quote, if you think about it, you have a pension fund here that would be invested in some other fund. That fund might be invested in another fund. And then yours and my money might be in the same fund. And then someone else's fund is in the same fund. And they have invested in the same companies. We are very interconnected in how we are invested in global markets." Unquote. The problem for advisors when trying to understand how good a fund is, Miss Melis says, is that even with due diligence, it can be more of a challenge to spot systemic issues, particularly when it is an event that has not happened before. Quote, "Individually, wealth managers will not know. They will invest people's money in the best products they can, with the data they have. When it turns out that some of those have completely lost value, you have to start to wonder why that has happened and whether there has been a circumvention of rules. Are the rules good enough for that type of vehicle? Are the funds too big? Are they seeking riskier returns than they should by their share size? In fact, are the private, closed-ended funds less risky than these really large funds seeking a return that is difficult to achieve in a normal conventional strategy? Finally, is it because of a valuation issue or an oversight issue?" End of article. The main thrust of Monique's article was primarily to do with striking a balance between consumer protection and over-regulation, but we basically read that portion associated with risk in terms of equity investment, especially when there are a host of financial products, funds and derivatives available, which on occasion mix many of these investment vehicles together. As Monique points out, mortgages, or should we say mortgage lending products, were packaged nicely into various forms of asset classes and vehicles via securitization in the main, creating mortgage-backed financial derivatives and sold as high-quality asset class investments, even though those selling them knew this was not the case in all instances, which then inevitably led to the 2008 collapse. The concern today, or at least a possible concern, has more now to do with how equities are packaged into various funds, especially while markets are reaching all-time highs. It is generally considered within the banking fraternity that there are sufficient checks and balances in place to prevent the mortgage meltdown we saw in 2008. However, another lurking worry are these funds and fund of funds, which essentially are all investing in the same shares. Now, we alluded to this in a recent previous video where we highlighted that many international funds were to a large extent heavily vested in US equities, even though they were meant to be global or international funds. Monique is pointing out that there is the distinct possibility that perhaps too few equities are being invested in by major fund managers and fund of fund managers, so much so that the slightest hiccup could cause many of these funds to come crashing down, almost like dominoes. She also points out that this problem is being exacerbated by the fact that those advising clients to invest in such funds are, to some extent, innocent, naive, or negligent due to their unawareness of such concentrations. In some cases, it may even be none of these, just the fault of the systemic way in which such funds are created, and not the advisor's fault at all. Now, in addition, with so much emphasis on performance, and now relative transparency on market performance, in other words, we can all see through various apps and online sites the performance of various funds. The pressure is certainly significant for advisors and fund managers to perform and outperform one another, which also could potentially lead to riskier investments being adopted, and thereby greater ramifications when this orbital equity path comes to an end. There are many financial Armageddon scenarios, and this is just one of them. What do you think? What do you think will be the cause of the next financial crisis? Do share your thoughts. And while you are contemplating them, if you haven't already done so, please subscribe to our channel, press that bell sign, and pop over to illuminatisilver.com and sign up as a free or paying member. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.